Assalamualaikum Warahmatullahi Wabarakatuh. Hi friends. I am Anggun Septiarini with NPM 244120031 from the Accounting Study Program. I will explain the meaning of accounting, the function of accounting, who users of accounting are, and the accounting process. The first is the definition of accounting. Accounting is the identification, recording, classification, summarization and reporting of transactions in a systematic manner and content based on generally recognized standards so that interested parties can know the position of a financial entity and the results of operations at any time necessary, and various decisions can be made. Alternative actions in the economic field. Then, the accounting function. Accounting has several important functions in an organization or business, including 1. Recording. Accounting functions to record all financial transactions systematically and chronologically. This includes purchases, sales, payments, receipts, and other transactions. 2. Classification. After being recorded, these transactions are then grouped into certain accounts so that financial information can be organized and reported properly. 3. Preparation of financial reports. Financial information that has been recorded and grouped is then compiled in the form of financial reports, such as profit and loss reports, balance sheets, and cash flows. This report provides an overview of the company's financial condition. 4. Financial control. By having clear records and reports, companies can monitor cash flow, control expenses, and analyze resource management. This helps ensure that funds are used efficiently. 5. Planning and decision-making. Accounting provides financial data that is important for creating strategic plans, setting budgets, and making business decisions that impact the company's future. Next is who the accounting users are. 1. Investors. Investors, advisors, and shareholders need information to help determine whether to buy, hold, or sell their investments, as well as assess an entity's ability to pay dividends. 2. Employees. Financial information is needed to determine the stability and profitability of the entity, as well as to assess the entity's capabilities related to the level of employee welfare. 3. Lender. Financial information is needed to decide whether the loan and interest can be paid when due. Scope of accounting. 4. Suppliers and other business creditors. Financial information is used to decide on cooperation regarding the ability of the outstanding amount to be paid when due if the purchase is on credit. 5. Customers. Financial information is used by customers to assess the viability of an entity. 6. Government. Financial information is needed to regulate entity activities, establish tax policy, and as a basis for compiling national income statistics. 7. Society. Financial information is used to help the public by providing information on the latest developments in the condition of the entity. 8. Management. Financial information is used to assess performance during the period and as material for future business planning. The accounting process is a series of activities to record, summarize, and report an organization's financial transactions. Following are the stages. 1. Transaction identification. Recognize and identify all transactions that occur in a certain period, be they purchases, sales, or other transactions that affect financial conditions. 2. Transaction recording. Journal. All transactions that have been identified are recorded in a general journal or special journal according to their type. This recording usually includes the date, description, and amount involved. 3. Posting to the general ledger. Transactions that have been recorded in the journal are then transferred to the general ledger to group accounts according to type, such as cash, debt, and income. 4. Preparing a trial balance. After all transactions are posted, the balance of each account in the general ledger is calculated to ensure that the total debit and credit balances balance. 5. Preparation of adjusting entries. At the end of the period, adjustments are made to certain accounts to reflect actual financial conditions, such as depreciation, accrued expenses, or accrued income. 6. Preparing financial reports. After adjustments, financial reports are prepared which include profit and loss statements, changes in equity reports, balance sheets, and cash flow reports. 7. Closing entries. To end an accounting period, temporary accounts such as income and expenses are closed so that the balance of these accounts becomes zero to start a new period. 8. Reversing journal, optional sometimes, Reversing journal is prepared at the beginning of a new period to manage transactions that are transacted repeatedly. That is the presentation material that I can convey. If there is a mistake, I apologize. I ask Allah for forgiveness. Wassalamualaikum warahmatullahi wabarakatuh.